couple of weeks ago, I was just blown away by the advice that my client was getting from their incredibly competent, intelligent CPA. The CPA was basically saying, "Oh my gosh, what are you doing? You are running your business into the ground. You're going into the red. You need to pull back on all these crazy expenses that you're running." Now, just imagine for a moment being on the phone with your accountant and hearing that. I mean, that causes, I don't know about you, but it would cause some anxiety and stress for me. The thing is, the accountant could not be further from the truth of the entire situation. Now, is the CPA lying? Absolutely not. The CPA is looking at data that is available to the CPA, which is all looking backwards. So I'm going to share a little bit more about that story, but first I want to say welcome. Thank you so much for being here. My name is Amber Duggar, founder of Profit for Keeps. And in today's Profit for Joy video, we are going to be talking all about how knowing your numbers can make or break your business and what numbers you actually need to care about and why. So let's get back to this story. So my client was on the phone with the accountant and really starting to go, this doesn't make sense to me. And so they sent me a Voxer and we were able to talk through it. But basically, whenever you are looking to pivot your business and you're looking to take it to that next level, there are all sorts of things that you're going to be investing in. You're going to be investing in additional coaching. You're going to be investing in new members on your staff. You're going to be investing in possibly upgraded tools. There are so many things in the business that require additional investment as you grow. And a lot of times, just like with anything in life, a lot of times you make that investment before you receive the return. So a lot of times it's like the chicken or the egg. Should I be investing in my business or should I be waiting to make money? And I can tell you that the answer is almost always invest to then truly create the space for that income to come in. So my clients, while the accountant was definitely thinking in the right way in terms of trying to protect his client, unfortunately, he was looking at a very limited amount of data. So what are we talking about here? Well, when you have a business that you're only looking month to month information, and I'm talking financial statements, you're going to see a window in the past of what's going on. So for example, in this accountant's eyes, he saw a lot of additional investments being made that in the month that he was looking at, the 30-day window he was looking at, he was seeing more money coming out than going in. So just taking a step back and thinking, okay, if a business is making 30 grand a month and they just had 60 grand go out the window or go out, that's a deficit of 30,000, right? We all can do that simple math. So you can imagine these are all theoretical numbers. You can imagine a CPA looking at that information is going, what in the heck are you doing? So now let's take a step back further and look at a bigger picture. A business that has been very intentionally, purposely profitable and sustainable by, on a regular basis, knowing how much money the business is requiring to be able to pay themselves, to be able to cover their personal taxes, to be able to cover the expenses of the business, and to create a buffer, a runway for the business. So this client has been doing this for several years now. We have been looking at creating that personal buffer, the business buffer, etc. And this particular client is so incredibly buffered, if you want to call it that way, or has a significant amount of savings that they could go months without making any money and they would still be able to pay their expenses. But that's not what the accountant knows, and that's not what the accountant cares about. Their accountant is looking at the last 30 days and saying, you're not profitable. What are you doing? As the CFO of your own business, as the strategist of your own business, there are key numbers that you want to take a look at to fully understand where your business is financially and what you're doing. So we'll revisit the rest of this story later on in this video, but I first want to just put it out there that what the CPA may be looking at is not actually what's going to be most beneficial for you as the CEO to be able to run your business. So what's the difference between stale data and real-time data? Stale data is anything that you looks behind you, sales you've already made, expenses that you've already paid for. Real-time data, when it comes to cash, is how much money is coming in this month? How much money is coming in next month? How much money is coming in the next 6 months right now in my business from a month-to-month basis? The other thing is, what are the expenses I'm going to need going forward? We already know it already happened, but what expenses do we have going forward? Do we have that figured out? Do we know what the revenue goal is for that particular, all of those expenses? Do we know how much we want to actually be hitting to ensure that we're still profitable? These are questions you want to ask yourself when you're thinking about only relying on a bookkeeper or a CPA to manage your finances. It is absolutely essential, in my opinion, for any CEO that truly wants to embrace permanent profitability to fully understand the numbers. And that does not mean you need to get an accountant's degree or you need to understand your bookkeeping software. It's key numbers that you don't even need to go into QuickBooks to figure this out. Okay, so when you look forward with your numbers, you're being intentional about, one, setting a very clear picture of what it is that you desire, what it is that you are looking to bring into your business, but you're also looking at real-time needs, real-time awareness of where your business is growing. So here are the numbers that you really want to take note on. And this is when I would highly recommend you grab a piece of paper and pencil to take some notes here. So the very first thing is you want to know what your monthly personal expenses are, including those true expenses that we talk about. If you haven't watched one of our videos on true expenses, we'll link it below for you. The second thing that you really want to know from a numbers perspective is your monthly business expenses. This includes not only your monthly expenses, but also your annual expenses, any future needs that you're going to have. If, let's say you're going to bring in a new social seller, or you're going to bring in a new marketing person, or you're going to bring in a new executive assistant or virtual assistant. Those are things that you want to know in terms of how much it's going to require from your business as you bring those people in. Okay, the third thing that you want to know is your intentional profit percentage. Now, what does that mean? Your intentional profit percentage is the percentage that you would like to intentionally put aside for profit before you're covering your own owner's pay, that before you are covering your business expenses, before you are covering your own taxes. You want to know what that intentional profit percentage is. Now, I always recommend that clients start at 5%. If after calculating their revenue goal, they realize, you know what, this doesn't feel good to me, you can bring it down as low as 1%, but you always want to start with a minimum of 1 with the intention of never going backwards with your profitability, with one exception. And that one exception can possibly be when you are pivoting into the next stage of business, you can intentionally reduce your profit percentage to allow for additional room for you to invest. So that's the exception there. But we'll make a separate live on that because that's definitely something to talk about for sure. So far we've covered personal expenses, business expenses, and intentional profit percentage. So that's 1, 2, and 3. Number 4 is your tax percentage off of your total revenue. Now, you're never going to know this right away. So this is something that you want to work on with your accountant for sure and say, all right, let's say over the last year, we made $300,000. This year, we're projecting $800,000. Of that $800,000, I'm projecting roughly this amount of expenses. So based on that, what is the amount that you believe I will owe from a personal tax liability perspective? Now, every country is a bit different. So know that this is something you definitely want to sit down with your accountant to determine. The reason you want that percentage based on total revenue and not based on your effective tax rate is from a cash flow management perspective. Just imagine receiving $100 from a client. You want to know roughly how much you want to set aside for taxes before touching the money for anything else. And so that percentage is really, really helpful to have. Okay, so that's number 4. Number 5, we're getting to the end of this list. Number 5 is your revenue. Your month-to-month cash in the door, not booked, cash in the door revenue. You want to have a really clear picture of how much you have had in the last 6 months and also how much you plan to bring in that has already been booked in the future. This is so essential in terms of running a profitable, sustainable business, because you can take action by being proactive versus reactionary by no longer saying to yourself, okay, how much money do I need to bring in to pay my bills next week? This is a very common scenario for many businesses, and my heart's desire is for you to truly take this information and help you implement a strategy where you are no longer reacting to the cash flow needs in your business. And this is all part of it, knowing these numbers. So again, revenue, you want to know the next 6 months, how much is coming in month by month, and you can easily track this in Google Sheets. You don't need anything fancy for this. It's literally a list of your clients, their monthly payments, and months across the top, clients along the side. You can absolutely do that, even with a piece of paper if you want, if you don't like spreadsheets. Okay, so that's number 5. Number 6 is something I've kind of already covered, which is that revenue in the future, that booked revenue in the future. Now, there's a combination here. You want to know how much you already have booked from previous sales that are recurring sales that you have, but also you want to have an idea of what the potential gap is between the amount of money that you need to be making month by month and the amount of money that is currently coming in. This is going to help you with your strategy in terms of what you want to be focusing on quarter by quarter to ensure that your business is running profitably and sustainably. So again, I'm going to repeat these one more time. Number 1, personal expenses. Number 2, business expenses. Number 3, your intentional profit percentage. Number 4, your intentional tax percentage off of total revenue. Number 5, your monthly revenue number, cash in the door. And number 6, your forecasted cash in future revenue. Now, what do you do with all this information? Well, first of all, I want to say if you are really interested in making this happen, this is something that we believe every entrepreneur should have the opportunity to calculate, to get very, very clear so that you can make these intentional decisions in your business and you can truly start paying yourself regularly. You can truly start feeling very confident about the revenue needs of your business, and you can no longer have to feel like you need to rely on someone who is looking only in the immediate past. So let's go back to my client's story. This client knows from the implementation of the Profit for Keeps framework that they have the ability to, 1, sustain themselves without additional revenue coming in at the moment because they definitely have reserves. 2, they have a really clear picture of how much money is intentionally coming in the next 3 to 6 months. And they also know that by making these intentional investments, they can expect that their revenue is going to increase, which will then absolutely put them back in the green. So it's that interim period that the CPA is freaking out about, but my clients are extremely confident in the strategy they're using, the investments they're making, and their overall financial picture. And that's what I desire for you as well. So if you're interested in this, I highly recommend that you join our next challenge, and you can sign up at amberduggar.com/challenge. If you enjoyed this, please do share this video with others. And if you're watching this, we would love for you to subscribe on our YouTube channel, like this video, share it with others. We so appreciate you. And if you have not yet joined our incredible community over at Sweet Life Purposeful Money, head on over there and join us. We have incredible weekly lives. We have all sorts of things going on in there. And if you're watching this and really resonating with the content, please do let us know in the comments. We'd love to hear from you. All right, until next week, much love to you all.